Well, good afternoon. Hello, everybody. My name is Mike Lehman from IFA. Thank you for joining us today for our program on the Small Business Administration's new lending rules and on what we know and what you can expect moving forward. Today, you will learn about the history and context of the role of the Small Business Administration, especially after it finalized a new rule on affiliation standards that becomes effective later this week on May 11th. And this program is being recorded. Today is Tuesday, May 9th for your context, but this information will be relevant for a long time, and it will be available to IFA members on our community hub website, which is communityfranchise.org. Again, communityfranchise.org. So you can recommend this recording to your friends and colleagues. And if you have any questions during today's program, please add them to the questions box and we will address them at the end. We have a great panel of experts today that we're very excited about to make sense of the new landscape for franchise lending in light of the Franchise Directory recently being eliminated. And I'm going to introduce later in the program Caroline Taylor, John Moshier, and Richard Snow. They comprise our lending panel, and they will share their expertise and perspective in sort of a fireside chat, which should be really good. So look forward to that. But first, we're going to share the history and context of SBA lending in the franchise space. And so before I yield to our first speaker, I would like to thank our sponsor on the next slide, Reg Bird. Reg Bird is president of SBA and bank financing at Benetrends. He has nearly 30 years of experience in business development and finance, very highly regarded gentleman in the SBA financing space and the franchising community. So we're thrilled to have Reg today. But before you hear from Reg, I am going to first turn it over to Edith Wiseman, who is president of Fran Dev. Edith has long been a key figure in understanding franchise business model best practices. She has deep financing expertise and has long worked with the Small Business Administration on access to capital issues in the franchise space. So I will get out of the way and now yield to our good friend Edith Wiseman to start today's program. So welcome, Edith.
Thank you. Yes, SBA is getting out of the effing business, the franchising business. Why is SBA getting out of the franchising business? To really understand this, you have to have perspective on what SBA is trying to do overall. So the SBA has two new rules that are coming into effect in this month, in 2 and 3 days respectively. So the first rule is called affiliation and lending criteria for the SBA business loan programs. That's the rule that we're most familiar with in franchising. The second rule is called the Small Business Lending Company, SBLC, moratorium rescission and removal of the requirement for a loan authorization. These two rules, next slide. SBA has an overarching objective with these two rules. It's to simplify the program and to expand the program. So if you think about the PPP program, what it did is it gave access to more small businesses loans or money, and more lenders came into the program. So before PPP, there were a number of franchise businesses that could not gain access to SBA loan programs, and there were many banks that were not participating in the program. Well, the amount of money that SBA put out into small business hands during PPP was unprecedented. And so what SBA realized is that, wait a second, there's an opportunity here. We can get more money into small businesses' hands, and we can bring more banks into the program. So that's the overarching objective. That sounds like a pretty great objective, right? Well, if we take a look at what these rules do and what it means, I think it's helpful perspective to know why there's been such broad dissent against these rules. So the first thing is that the rules eliminate 9 pages of franchise affiliation. What does that mean? Hooray! There's less regulation. Rip up those pages. I think everybody can get on board with that. The second thing that the rules do is it eliminates tracking franchise loan performance. My view is that this is also a hooray. There's no more potential for bad news articles that those in the media like to point to the SBA data and say, look, franchising's bad. Look at these franchise brands that have bad performance and charge off and are costing the taxpayers money. Well, the reality is that that performance data has always been flawed and not accurate. So it's good for the franchise industry, but I think it's also important for everyone to recognize that lenders really do need data in order to lend to franchises. So they're going to have to find performance data from another source. The third thing that the rules do is it eliminates the franchise directory. So while the SBA was vetting for franchise affiliation, when a brand got on the directory, they were also vetting for franchise eligibility. So the rules put the onus and the risk of determining eligibility into the lender's hands. So what SBA has always believed is that franchise eligibility is a lender's problem. That's something that they should be doing. But when it comes to franchises, it's something that lenders have not been doing for years. They haven't been reading through hundreds of pages of franchise documents. What the rules also do is it tells lenders that they're no longer getting guidance from SBA for lending criteria. So if you think about SBA lenders, well, you'll hear from them later, they love rules because if you follow the rules, then guess what? Your guarantee will be honored. But now SBA is saying, do what you do. That's kind of a broad statement. The rules also open up the program to fintechs. So previously, there was a moratorium on those institutions who were not federally regulated, their ability to offer SBA loans. So this rule, the second rule, which will go into effect the day after the affiliation rule, will open up the program to potentially countless numbers of fintechs. So next slide. At first blush, if you go back to the objective, simplify and expand the program, we could all get on board with that. So why is there so many fears? And what are those fears that lenders and frankly, Congress had? So there was a Senate hearing and there will be a House hearing about these 2 rules. The first is that with these affiliation standards simplified, there's just concern that lenders are going to finance big businesses. The chair of the Senate Small Business Committee even referred to franchise lending, possibly that there's going to be some lending to some big businesses like franchises. They're also concerned that franchisors are going to play fast ones. So franchisors are already giving lenders a little bit of pushback, telling them that they're going to be changing their documents, they're not signing certain agreements. So there's this concern that that there's not going to be a big brother in the room, so to speak. Lenders are afraid that they're going to make poor franchise credit decisions with the lack of SBA data. When they had SBA data, they could at least point to, well, SBA, you say your loan performance is pretty good with this brand, so I can make a loan to the same brand and not have it be questioned. And that the do what you do standard that SBA is giving to lenders, that it's going to provide an uneven playing field. So when they're opening it up to fintech, there has the potential to be aggressive and volume-driven lending, and it could lead to a degradation of the loan quality performance that could actually jeopardize the entire program. Next slide. What we're used to, both franchising and lenders, we're used to change, right? Every single time there's a new political appointee, SBA seems to change the rules as it relates to franchising. So I think that you should continue to get used to change. I'm sorry to say, but because there's so much dissent in Congress, they may very well decide to change and negate these rules. But until that happens, what we have to understand is how do we operate within the framework that is going to be in effect starting May 11th. And to do that, I think it's helpful for you to know that over the past 5 years, SBA has determined 200 brands are not eligible. That's not affiliation, that's not eligible. I was shocked when I heard this number. I'm curious if you're also surprised by that number. So that's 200 brands. There are over 1,000 brands that have eligibility notes attached to their listing on the franchise directory. There are over 1,000 franchisors that have a customized franchise addendum. And there are about 1,400 franchise brands that have the word collateral in their eligibility notes. So a lender has to try and sort through all of this. Okay, so if a brand has a customized addendum, does that mean they have eligibility issues in it? Those eligibility notes, who else do they apply to? Like, does that explain all of the issues that we need to cover? So a lender has to sort through what will no longer be available to them, which is the franchise directory. So I will tell you, every lender has been downloading that directory to make sure that they have a copy of it and it's in everybody's hands. And SBA lenders only make loans to franchise small businesses because they have a guarantee by the government. And that guarantee can be anywhere from 50, and sometimes it's gone all the way up to 90%. So if they do anything wrong, that guarantee is potentially jeopardized, or it can in total, or jeopardize in some small piece or portion. So the question is, how do you make this change actually work to your advantage? And I don't mean take advantage of lenders, but just work in your advantage. Can you go to the next slide? Lenders are now trying to plan how are they going to move forward starting May 11th. Now they have 30 days to actually follow the rules, which really SBA has not actually issued. So there's guidance that they'll be giving soon. But what I've been told by lenders is that this is a little bit of a back to the future situation, wild west, if you will. So because SBA has created a vacuum, they're not determining eligibility for franchise brands. So what can lenders do? Well, they can make the decision themselves. So some lenders have a role within their organization, which is an eligibility officer. Their entire job is to make sure that the loan that is being processed is eligible. The second is they can hire an outside attorney. So they're going to have to pay for, someone's going to have to pay for that. The third is they could just pass on the opportunity. Sorry, not willing to take the risk. Don't want to take on the added expense and time. The third is they can send it through what's called SBA general processing. So a lot of lenders are what we call preferred lenders, which means that they have been given the authority by SBA to process an SBA loan without SBA's input at all. So they can do it faster, better than if they had the government kind of slowing down that process. But every lender has the option to send in a loan to general processing so that they get SBA's stamp of approval. That SBA stamp does come at a cost, and it's called a time and frustration cost, not an actual dollar cost. And there is a potential that that system could get overloaded if too many banks use it for this purpose. And the final is that lenders will use the services of Fran Data to make sure that they have the eligibility component secure, and that their franchise loan performance is actually being vetted, and they have the credit assessment with the lack of SBA data to support them. You go to the next slide. So what can you expect? you're going to get treated differently by different lenders. So some lenders, they're going to ask you to sign a certificate of no change or non-material change that used to exist many, many years ago. I'm sure some of you remember that. Some are going to continue to ask for the addendum. Some are going to hire outside counsel. When I was at the recent SBA conference, I was talking to an SBA counsel and he said, "Oh, this is terrible for lenders, but it's good for me." So, and then if they send the loan through general processing, you could get absolutely different comments. So you expect to be treated differently. I think you can also expect there'll be some increased mistrust between lenders and franchisors, especially if there's the sense that that franchisors are changing their documents and lenders can't understand the reasons why, and will it affect their loan guarantee? And finally, I think that new brands and small dollar loans are going to be affected the most. New brands, at least for existing brands, there's some sort of guidance out there that has a little bit of a shelf life. So that directory that's out there, there's going to be a shelf life that lenders say, okay, well, as long as they haven't changed anything and I can validate that, then it's good. But new brands, there's no reference points. And for small dollar loans, they're just not profitable enough to take on the additional risk, time, and resources to deal with. So I think that they'll be affected the most. Next slide. But there are things that you can do to make SBA lenders give you and your franchisees the effing money, the franchising money, which is you can do, if you have a customized addendum, those of you who are in the 1,000 brands that have a customized addendum, make sure that you contact your Fran Dev representative so that that addendum can be looked at and the affiliation language can be stripped out, and anything that is eligibility specific, the information can be posted on the franchise registry account. So lenders have that documentation readily available and you don't have to get treated differently by each lender. There's also going to be a proprietary customized certificate that will address all of the lender concerns around eligibility. So you want to make sure to get that signed and also available to lenders to download. Don't try and take advantage of this situation just because SBA is really no longer involved in franchise lending in a way that they have been before. And then finally, the way to build a trusting relationship and a smooth process is with the lack of SBA performance data. It's going to be really important for you to know your fund score, which is like a FICO score on your brand, because lenders are going to be relying on that fund score even more so now than before because they don't have any SBA data to point to. So there are things that you can do. Change is scary, but you can make change good for you and your brand and your franchisees to make it a smooth, seamless process. I'm going to now turn it over to Reg, who helps lots of franchisors and franchisees get SBA financing to get his perspective on these changes.
Thanks, Edith. You bring up a lot of very good points about the recent changes and what is about to change here in just a few days. So thank you for bringing that to everybody's attention. My approach today is going to come from a little bit different angle, in as much as we've been in the business of placing franchisee financing with lenders myself for over 20 years. Benetrans Financial is in their 40th year anniversary. So we have a tremendous amount of experience, decades of experience in making sure that franchisees get the financing they need to start their business. So sure, the SBA is removing the SBA directory, but from where we sit, it doesn't make a huge impact on the lender's approach to a loan request. So for example, the elimination of the SBA Franchise Directory may seem like a significant development for the industry, but in reality, the fundamental processes for securing franchise funding haven't really changed at all. The onus is with the lender, and really as it has always been. So the SBA's message to lenders is do what you do, as Edith mentioned, and that is a pretty broad statement. But really, when you hone in on that statement, what we're seeing is that, and thinking about here, is that lenders must remain consistent and compliant with the SBA's standard operating procedure. So banks will still be responsible for the exact same due diligence as they've conducted in the past. They have a fiduciary duty to read and review and vet franchise agreements. That's always been their job, to be sure that the deals that they're taking on are going to be successful. As part of our due diligence in-house here at Benetrends, when taking on new brands, be they brands that are emerging or otherwise, we have staff on our team who will scour franchise agreements to ensure they meet SBA requirements. For example, we have one gentleman on staff who is a former SBA lender. He actually came to us from a bank where he was the chief credit officer. And so he is very familiar with practices that banks have had for many, many years in making sure that the FDD is in compliance. And by doing this, we're ahead of the game. So when a client is introduced to a bank, we're confident in the brand's FDD and are able to share our insight with the bank about what we have found in the FDD and point them directly to anything that might be of any concern that they can look at on themselves independently. And as Edith said, attorneys are going to become more involved now than they have over the last 5 years. And we definitely see that happening. We've talked to some banks who are going to be hiring, maybe not general counsel, but hiring paralegals or somebody in the legal discipline who are going to be helping out at the bank, reviewing FDDs and making sure that they're in compliance as well. But nothing changes with the lender's approach toward prospect borrower underwriting practices. And this is just a little bit more of the same, but this is the whole spirit of the message I'd really like to deliver today, is that the bank's obligation to adhere to SBA standard operating procedure remains the same, regardless of whether there's an official or unofficial directory of approved brands. Our team has assisted brands getting placement on the directory for quite some time now. And what we've been running into is that the turnaround from the SBA has slowed the process down more than anything in the cycle or in the journey of getting the financing in place for our clients. Sometimes for several months, it's taken the SBA to turn around an approval for a brand to get on the directory. So that part of the directory, we're not going to miss at all. It's going to make things a little bit more smooth from where we sit and from where the brands sit in terms of timing and getting deals flowing through the journey to ultimately get the financing placed. The changes in the SBA policy apply to all small business loans, not just franchises. And they're very much going to, banks are very much, or I should say the SBA is very much still going to be, of course, in the franchise business, because the standard operating procedure, the SOP, applies not just to franchise businesses, but to all businesses. So the approach is still the same, ensuring that, let's say, if it's a license agreement and not a franchise agreement or otherwise, that it's still in compliance. Absence of the directory is not going to have a significant impact on business-centric SBA lenders. Edith brought this up a minute ago as well about preferred lending partners. Now, our position has always been that we only have relationships with preferred lending partners, or known as PLPs. The PLP designation has been awarded to banks by the SBA because of the bank's track record in processing loans, SBA loans. So this is something that doesn't come lightly. The PLP status has to be earned by a bank. In fact, they go through stages. They're first without any designation, then they'll go to a certified lending partner, and then ultimately become a PLP partner. Earlier today, I was remembering years and years ago when a bank that I used often for hotel funding became a PLP, and they were having a party and balloons and everything else, because this allowed them, as it does PLP lenders, the authority to approve loans in-house without requesting approval from the SBA. PLP lenders are typically at a national level. Sure, there are regional banks as well that have the PLP status, but they're very seasoned. And to have to send something out to an SBA office, a regional office or otherwise, the PLP lender knows is just going to slow everything down. And a bank is always interested. Some people don't quite think about this, but banks want to get deals done, and they want to get them done fast. They want to get them done quickly. Of course, due diligence has to be in order, but they want to get them through the journey. So to avoid having to send files out is the ultimate objective of a PLP lender. The other point here is that the SBA program has been alive and successful for 70 years. It was initially started after World War II, and the spirit of the program is still very much the same. And the directory, when we think about it, we put this in perspective, the directory has only been in place for 5 years. So lenders know what to do to remain in compliance without it. I think where the fear comes in might be with franchisors, with brands merging again or otherwise, who didn't know what it was like before the directory. Well, I want to tell you, it's going to be okay. Loans are still going to get done. And Mike, you mentioned the other day, the message really from where I sit is, the sky's not falling. We're well equipped with proactive internal best practices of how we connect qualified brands with lending partners before we even see a referral from a brand. So we'll work with the brand who's come to us and said, hey, can you get financing for our franchisees? Well, let's take a look. Let's look at your FDD. And we have these best practices in place with the staff we have, the very seasoned staff with decades of experience who can review the FDD and find anything that we need to be aware of that, as I mentioned earlier, we can then pass on to lenders. So with these practices in place, we're prepared for funding prospects to roll in, knowing that we have lenders in waiting. And then just a couple comments, quick bullet points here. Banks are more active than ever, folks. We're getting banks who are calling us and they want commitments from us on a dollar volume of how many deals we're going to give them a year. They're busy and they want our business. Small businesses are growing. Money continues to flow. The White House stated on May 1st, just a few weeks ago, that the past 2 years have seen the 2 highest years in business applications on record, as Americans applied to start nearly 10.5 million small businesses. Now, I wish we had all of those 10.5 million applying for SBA loans, but we're seeing, of course, a nice chunk of those to help folks realize their dream. Those are some points that I wanted to bring up just to really bring from where we sit here at Benetrends a very realistic approach, knowing that sure things are changing, but they're nothing that that can't be overcome, that are going to slow anything down. So I thank you for the opportunity and would love to answer any questions that might come up as we move forward. But Mike, I'll go ahead and turn it back over to you, sir. Thank you.
So great. Thank you, Reg and Edith. We appreciate both of you a great deal and sharing your expertise. And I think we had a feeling that we would have some different takes and predictions on the new landscape. And maybe we've already had a bit of that. And now we're going to move to our SBA lender panel, where we may get some more perspectives. I know we will from our great experts. So first, let me introduce our three SBA lenders before you hear from them. And actually, before I do that, let me say for clarity, again, if you have questions, feel free to enter them into the Q&A box at the bottom of your screen, and we will try to process as many of those with our expert panel as we can. Okay, first I want to introduce Richard Snow. He is our longtime friend, Vice President of National Franchise and Specialty Lending, Relationship Manager at Bremer Bank. Incredible experience in the fields of business management, business development, SBA, and commercial financing. So welcome, Richard. Our other friend, John Moshier, serves as the CEO of the small business lending at Ready Capital. He has over 25 years of lending experience, and 20 of them have been focused on SBA loan programs. So we're thrilled to have John. And I want to yield first to Caroline Taylor in a moment. She is Senior Vice President and Head of SBA Lending at Regions Bank. So welcome to all of our lender friends. So we've heard from Reg and Edith, and Caroline, I wanted to turn to you first, as I mentioned. Edith said different lenders may view the new rules differently, depending on where they sit. So high level, what is your view of the new rules and the elimination of the directory? And how does your institution plan to underwrite loans to franchisee business people moving forward?
Yeah. Well, first of all, Mike, thanks for having me amongst this great panel. No, it's interesting times, and times I've been in SBA lending for over 15 years that I've never seen before. And I know Edith mentioned in her presentation that, lenders like rules. I'm a rule follower, but also I am about simplification and how to make it an even playing field. And when I think about some of the rules that change, a lot of things that stick out in my mind is the how. How are we going to implement this? How is it going to impact us down the line in the future? Our industry as a whole. We are all about opening up the program to a certain extent, but we want to do it in a very methodical way. And we want to make sure, I say sitting as a lender, that we all are adhering not only to the rules that SBA is giving us, but, we have to report to our regulators. And what does that look like? I would say that as we have come out of the PPP world, we know that fintechs have really grown in that space. But also we've seen at the recent conference that SBA lending has really back to pre-pandemic levels. And we are lending at the level prior to like 2018. And in that small dollar space, $150,000 loans are being approved more and more. So when we think about some of the rules that have been implemented, what comes to me is like, hey, we're going to continue to do business as usual. We are going to be very risk focused, and we're going to adhere to our credit policies that we have internally. We have experts in the field that we will continue to lean into that know SBA lending. We talked about being that PLP provider. We are a PLP provider at Regions Bank, and we take very seriously the SOP and making sure that we are giving our clients the best product, but also adhering to our regulators and really evaluating the risk to our bank as well. So it's with mixed emotions because we do want to simplify. We do want to make sure we're getting capital to our small business owners, but we also want to do it the right way. And we know how to do it the right way. And sometimes having rules in place is very helpful. Again, when we talk about removing the register, how do I feel about that? I have mixed emotions. We also partner with Fran Dev. So I'm not really concerned with that being gone, that we won't have the tools that we need to make the right decisions, because we also talked about we're still going to do our credit the same way. We're going to still do our proper due diligence. And, we have a franchise vertical within Regions that we have expert franchise bankers that we will be leaning on when it comes. But I think it is still going to draw that. It's going to be a wait and see. And we're going to have things in place to make sure that if it's 2 years down the line, 5 years down the line, that it's not an I got you moment or something was ineligible because we didn't have that directory to rely back on.
Caroline, very helpful. Thank you. John, let's go to you next. What's your view of the new rules and how is Ready Capital going to respond?
Yeah, thanks, Mike, and thank you for having us and allowing me to represent Ready Capital, we are a non-bank lender. We are one of the small business, the SBLCs out there in the marketplace, one of the 14. I know they're going to expand our expansion, but right now we're the largest SPLC in the marketplace. And it does, the challenges with running an SPLC is we are not a bank, so we do not fund our we don't have deposits that we carry to fund our loans. We work with larger banking institutions. We have warehouse facilities, and we go to the capital markets to help fund our loans. Some of the advantages and the gap fillers that we bring to the market are we do lend in the we're a nationwide lender, so we do partner with a lot of banks that either are regionally are actually doing business with different franchise brands that maybe they aren't able to lend in certain regions, or maybe certain brands that they're not comfortable with. We do also work directly with some franchise brand as well. To Carolyn's point, and the point earlier that Edith made, that we do like to follow rules. I think strategically, it's just a little bit of shift in how we, the process and how we go about doing it. I mean, the eligibility is still going to be the eligibility. It's just that the onus is on the lenders to determine that, with control and things like that. The new SOP is not out yet. I think all of us lenders are anxiously awaiting the new SOP that would give us a little bit more guidance on the policy side of this, but I don't suspect, I think we've got enough information through the rule changes that came out that will kind of help us determine it. I will say that the fund score is going to be our go-to as far as looking at performance. And I think as much as I liked getting the data from the SBA, but we're just going to change our focus. And I think the day that the rules are published, I made sure that we paid our members or check to Fran Dev, because we knew that this was going to be a really important partnership, for us, and helping us kind of map our strategies with the different franchises that we will be working with. I did see some questions in there that on emerging brands and things like that is I understand the concern there. I think for those of you guys who may be emerging brands or working with emerging brands, I think you just expect maybe a little bit more interaction with the lenders just to get to know you and understand your risk tolerance and what you're looking for in a franchise owner, to really kind of educate the lender on how you support the franchise, or maybe what the physical or the financial requirements are, and things like that. And as a non-bank lender, we that's really how we build our relationships with our franchisors, is we get to know them and continue to build off of that success on our end. I do need to put a plug in here because Ready Capital is a big sponsor of a show on Lifetime called Military Makeover, and I am a veteran myself, and franchising is really a really great opportunity for veterans to own a small business, and with a typical playbook that they get, and we found a lot of success in lending to the veteran community. So for those of you who do have veteran programs and do work with veterans and helping them obtain a franchise license, thank you. And we continue to reach out to our veteran communities to find access to capital for them and help them dream. So, thanks, Mike.
Yeah, thanks, John. As Edith has taught me over the years, franchising is roughly 20% of SBA lending. And of course, we have an outsized percentage of veterans and women and people of color in the franchise ownership community. And we're so pleased about that. And SBA lending has certainly been lifeblood for so many business startups and franchises. So let's go to my buddy, Richard Snow. Richard, you've heard from John and Caroline. Want to welcome you into the program. How's your view of the world moving forward?
First and foremost, Michael, thank you for allowing me to be a part of this prestigious panel. And I have to say ditto to what Caroline and John have mentioned, and Reggie and Edith. Every bank has that word community attachment in their mission and their vision, because they're going to be tied to that community. And our community is franchising within this national franchise space. So I think it's going to be even more important for you to build those local relationships. But understand, and one thing I wanted to highlight, I saw in the chat, the emerging brands, it will be important, almost essential to utilize Fran data because of the transparency, because we need to report back to our risk and our credit teams when we identify these brands to make sure that they're approved, that they're comfortable, that we can look at the item 19 and understand the financial performance, that they have an updated bank credit report. These are going to be essential to making sound credit decisions. That's going to be key. The banks will also begin to closely monitor the performance. They want to make sure that if you're financing these new brands, how do they perform on the portfolio? Because many of the institutions, they're either holding or they're selling these loans on the secondary market. And based upon that performance of that brand and how it performs in that secondary market, that's also going to be key in how the relationships begin to change, how they change their direction and vision on how those brands perform. I think also you want to look at industry analysis. We just had a conversation in our team at Bremer. We've been around since 1943. I'm in the Midwest working toe to toe and elbow to elbow with our community partners. And we went and had a conversation with credit. We showed them the IFA economic outlook that Fran Data put together. We spoke to them about partnerships with Fran Data that is important and utilizing these resources outside to use that as a lens to vet these brands. I think also in this inflationary market and what you've been seeing in the banking institution, a lot of banks, if they're going to take that additional risk, if they deem that to now be a risk, they're going to ask for full relationships. So begin to expect that. They're going to be looking for deposits or treasury management services. So there's the relationships going to have that want and need to be more holistic. So I think it will be business as usual for those brands for those institutions that already have national franchise credit policies. For the newer institutions that are getting into the space, they will need to build that out. But if you already have that in place, you already have a set of due diligence. You want to be disclosed and be as transparent to the institution as possible. I would also say for the emerging brands, if you have leadership that have a historical track record within the industry that's a part of your new brand, also speak to that. These are all wins that get the credit managers more comfortable with your brand and willing to provide that access to capital. So those are some of the changes that I've seen, and a lot of the partners that I've seen here. I've been able to see this through the eyes of Venetrans, through the SBA, and now in the commercial space. And you have to have that transparency of information in order to make that credit decision. And everybody here I know already utilizes that within their policy. So I just see that as being a little bit more enhanced and continue to move forward business as usual.
Thank you, Richard. So Caroline, if I can come back to you, John and Richard addressed the emerging brand, the system that hasn't been on the franchise directory in the past. What's your view of that? Does that get better? Does that get easier for folks who haven't or are not on the directory?
I wouldn't necessarily say it gets easier for folks. I go back to it depends on your experience and the comfortability of your credit box and the lending institution. I know for us, we have leaned heavily on that franchise directory as we built out our vertical, because as Rich alluded to, there are certain drivers that our credit officers and our risk partners want to see as we're building out certain brands that we're looking to really partner with. So from my standpoint, it would be more cause pause, but I wouldn't say it would stop. We will look at them at a one-on-one case and have more due diligence, more questions. So back to those point and doubling down, it's going to be critical that you do partner with someone like a Fran Data to make sure you're being fully disclosed, transparent, and we can have someone give a good analysis of where you are financially in that, in your emerging space that would help us to get more comfortable with the brand.
Great. Yeah, great. So, John, maybe go to you next, and then certainly Caroline and Richard. What specifically will be different for franchisees in terms of their experience with lenders in this new landscape? What can franchise business people expect now?
and I mean, as far as the brand that they work or that they, buy into, I mean, I think it's business as usual as far as borrowing, or if you need to obtain capital or borrow money to make that dream happen. As a lender, we're going to need to probably vet some of these agreements out, or any changes in the addendums with the franchise agreements. We do have in-house counsel that's pretty versed in these franchise agreements, and if there's any emerging new ones that we're unfamiliar with, again, it's that relationship building and getting to know the heads of the franchisors, and just kind of really understanding, like, what is your risk tolerance and who you allow to represent your brand. And then, we can kind of determine if it's a good fit or not a good fit for us. But, for the most part, if there's a high level of understanding of how, what their profile is that they're looking for, and we kind of understand what their minimum to max, what their range is, then, we can probably build a pretty decent risk profile around that as well for us. We just give them the guidelines, and it could go from brand to brand depending on the performance of the brand to what their profile is of the franchisor that they give a franchise to, or allow a franchise to operate.
That's great. Thanks, John. Richard, and then maybe Caroline. Richard, anything specific different in your view from the franchise perspective moving forward?
Very concise in the information you provide. Know that liquidity is going to come into play very strong, and that post-closing liquidity left over in that secondary source of income. Because when we're mitigating risk, we're looking at, is there a secondary source of income that can support that household or that business if there's any type of challenges or cash flow issues. And we know we've been in an increasing rate rising environment where we've seen rates continue to go up and create a stress on that bottom line. So that's going to be even more important, that liquidity position. And who is that borrower? So emerging franchisors, be more critical in the vetting of your franchisees, making sure that you have the right person coming to the table, and that on that end as well, when we take a look at the businesses, and do you have the ability to sustain in the current market? Is it something that has visited historically friends? They really reach out the back.
Richard, it's hard to hear you. I'm not sure why, but I can't hear you right now.
Can you hear me now?
That's maybe better.
I'll fix my camera and go to Caroline. Caroline, I'll let you give an input if you can hear me.
Yeah, sure. I wasn't able to hear you all, so I apologize if I'm repeating, but I agree. One thing that we're really going to be looking into are the industries. Is it high, medium, low profile, going back to the risk perspective of that? And also when we think about franchises, we really lean into the training that takes place and learning about that, because normally the owner is not going to have that direct management experience. They may have someone in there. So really leaning into this type of associates that they're going to have, that lenders will probably dive deeper into, especially for an emerging brand, want to understand what that business model looks like. So I definitely echo what John was saying as well.
That's great. Thanks, Caroline. So I want to welcome Edith and Reg back into this conversation as well. Maybe Edith, a question, Patrick Kelly, the gentleman at SBA who's been driving these rule changes, seems to have suggested that this enhanced 19-point screening process for loans is going to be very important. So can you talk about those criteria and, effectively, will they replace the franchise directory in a way?
It's a really good question. So the first time I heard about that 19-point screening process was during the hearing, the Senate hearing.
Yeah.
So who knows what that is? And I think every SBA lender is waiting for either a procedural notice or the new SOP to be released to let them know what does that mean. So that was definitely news, hopefully good news, but it's a big question mark.
Okay. Any other perspectives on this 19-point screening process that will be part of the SOP?
I mean, I'll tell you what I hope it is.
Yeah.
The hope is that those 200 franchise brands that were marked as ineligible, the hope is that those will be screened out, meaning a lender can't actually make a loan to them. So that was, try and give lenders some safeguards. If it's not eligible, like tell everybody, so that would be a big win for those that they know. Now, the question is, who else is out there that hasn't been reviewed and marked as ineligible? So that would be the hope.
And I'm not trying to discourage anybody to get into the SBA lending arena, but for those of us who've been SBA lenders for a long time, understand what makes an eligible loan out there. I think those folks who are coming in who don't have a lot of lending experience, I think this is where I think some of the folks who've been doing this a while has some consternation around the do what you do, because this is an unsubsidized program that we deal with here, and those of us who are experienced, lenders in the franchise space, this is pretty much going to be business as usual for us. But they could these other lenders could take on risk, but then they could have a lot of loans go bad, and they may think they're eligible if you're doing what you do, and then later on may be out of the business pretty quick. So if I explain that correctly.
Yeah, thanks, John. So question in the chat says, for those 200 brands deemed ineligible, was there a stated reason why they were no longer eligible? What do we know about that?
So there is no list available that tells you who are the 200 that are ineligible.
Okay.
So are there known reasons why franchises are ineligible? Yes. So I can put out a laundry list of all the reasons why brands become ineligible. Some brands can make themselves eligible. They could be ineligible to start with, and then do some modifications to their business model to become eligible. And that's what some brands have done in the form of an addendum. But the 200 that are ineligible, there's nothing, they either haven't made the changes to become ineligible, or they just can't be eligible, period.
Okay. There's on the brands deemed ineligible.
What was the question?
The brands that were deemed ineligible on this list, as Edith mentioned, not made public, stated reasons for why they were no longer eligible. It's fine. We'll move on. Let's talk about that addendum. So if you're one of the 200 brands that's not approved, another question in the chat, what is the addendum and how do you get it if you need it?
So depending upon the reason that a brand has been determined ineligible. So I'll give a simple example. There are some brands, and this is the most simple, that cater to a specific gender, right? So if they ensure that they actually service multiple genders, right? So they are open to everybody. It's a federal program. So there are certain things like you can't push religion, you can't make loans, like you can't be a lender getting an SBA loan. So there's a certain stated things that are very explicit as to why someone's ineligible. So if you're selling CBD, you're ineligible. So those are some reasons, but then there's also collateral issues that if a lender doesn't secure the collateral properly and it's a franchise specific issue, meaning it applies to every single franchisee, then the addendum is what corrects that collateral issue for the entire franchise network. So those are just some examples of why someone might be ineligible.
Thank you, Edith. Any other thoughts on the addendum?
No, I think Edith made it real clear. The addendum, as she said, it'll address anything that is of concern that the SBA would find that would make it ineligible. It just cleans it all up.
Great. Well, we've just got a couple minutes left, and with 5 speakers, I want to give everyone a chance for sort of a last word on steps moving forward. So maybe I'll start with Caroline and close with Reg and go through each of our experts. Caroline, any sort of closing thoughts or other tips for business people seeking capital that you'd care to leave us with here today?
Yeah, I'll go back to a statement that was said earlier. The house is not on fire. We're going to get through this, and know that lenders are here to help. And we're going to try to find ways to continue to provide capital to those small business owners, that we believe in them, and that it's particularly regions we are set up where we have expertise in the field within our communities that will help to educate them on the right offers to get the capital that they need. And that franchise lending, we're here to stay in that space as well, and we'll partner with them on a relationship basis.
Great. Thank you, Caroline. John, how about you? Other tips for people as they move forward?
Yeah, I totally concur and agree everything Caroline said, and just additionally, it's a 3-legged stool. There's the lender, there's the franchisor, and the franchisee. And I think we always have to continue to align our interests. And as long as all of our interests are aligned and the risk is mitigated, access to capital, to help folks live the American dream and continue to support our veteran communities is paramount. So again, appreciate all the support that you guys, that especially the IFA does give the veterans as well.
Thank you, John. Richard, how about you? What thoughts would you leave folks with today?
I hope my sound is better. Can you hear me now?
It is better.
Yes.
Thank you.
Excellent. So one that we all talked about, make sure that you partner with Fran Dev, full transparency. That bank credit report, that report card to credit is going to be important. Come to the table with your best package. Strong borrower showing liquidity position, collateral. A strong borrower will typically offset a new emerging brand. So your vetting process, be strong within that. Select the right candidates that's coming in, franchisees that's coming into your brand. Remember, we are community focused. So it's important once you begin to partner with that institution, continue that partnership, because then we build up our own historical information and data regarding the performance of your brand. And also know, as what Caroline and John said, the house is not on fire. We've been through the worst of times, which was COVID. This time that we're currently in, we can maneuver and be agile in any environment at this time. And we are continuing to lend to our community, and we are continuing to be friends of the franchising industry.
Great message, Richard. You mentioned Fran Dev. Let's go back to Edith for any closing tips you would recommend to folks as they move forward, Edith.
Yeah, I think big picture, when we look at lending in general, what I have been hearing from lenders is that SBA is playing an even more important role right now, as lenders are experiencing a kind of a crunch in their deposits. And so they're pulling back conventionally. So SBA is important. So listening to what each of these everybody said on the panel, from Reg, Richard, John, Carolyn on down, is that you have to be more involved. You have to be responsive. You don't have to be, but that was my recommendation, in order to get over this time of change where everybody's going to be adjusting to this new normal. And as I said, this might not be a permanent normal. There may be an even newer normal a little bit further down the line. So that's what I would end with. But thank you, Mike.
Yeah, thank you, Edith. Reg, last word to you. How can franchise business people move forward.
I love everything I've heard today. It's really been very positive. I love the comments about the house is not on fire. Just as I mentioned, the sky is not falling. And in the franchise community, there are so many of us who support one another in franchise financing that it's very important to rely upon one another. As Carolyn said, you know, we're community outreach. We're here to help and rely on one another. That is just, it's so important. And in our team, as I mentioned several times when I was first talking about things, you know, we have processes, we have best practices, we have policies in place to make sure that by the time a client's file gets to a bank, we're making the bank's life as easy as possible. And that's really, I think, what lenders truly enjoy. They have enough of their due diligence to go through, but we'll make sure that lenders are getting exactly what they need.
That's great, Reg. Thank you for that. And that's all the time we have on this program. I think we made it through the big topics and the questions, and this was a delight, folks. Thank you so much to Edith and Caroline and Richard and John for sharing your expertise, and special thanks to Reg and Benetrends for your sponsorship. This is the power of the IFA community, that we can bring together 5 experts like these friends and share their perspectives on the issues of the day. Please feel encouraged as we close to reach out to the speakers individually as you see their emails on the screen. Just a reminder that this webinar is recorded and will appear within a day at community.franchise.org, community.franchise.org. Thank you again to our speakers. Thanks to everyone who took time to watch today's program, and have a great rest of your day.
Thank you, Mike.
Thanks, Mike.